investors in Asia should look forward to a moderately stronger global market in 2013. But how do you explain the disconnect between China's economy and the Shanghai market?
I think that when you look at China, there are two markets really. There is the offshore market and there is an onshore market. And both of them are driven by different factors. I think that in the case of the onshore market, which is the Shanghai market, it is very much driven by momentum. And it is driven also by supply-demand kind of forces. And over the past 12 months, I think that there has been a lot more supply in the market than demand. And I think that retail investors who dominate the onshore market in China tend to favor yield products or property markets rather than the stock market. And as a result of that, the onshore market has performed very poorly compared to, let's say, the offshore market, which is more correlated with global markets.
Would you recommend investors to go for A shares or H shares?
I think that the A share market, as you pointed out, the A share market in mainland China is obviously quite cheap. But as I said before, I think that a decision on A versus H depends very much on how you read the policy settings in China regarding equities versus property versus the high-yielding products there. And unless the sentiment towards equities versus property and high-yielding products in China changes, I'm afraid that cheapness by itself is not a sufficient condition for the Asia market to rally. So I think that we need to see the other factors favoring equities in China first before we can decisively say that the market has changed direction.
You raised your exposure to the Asia emerging markets equities. What do you make of the Southeast Asian markets?
Southeast Asian markets have had a tremendous performance over the past few years compared to North Asian markets. And so I think that they will continue to do that, by the way. We think that the steady growth nature of Southeast Asian economies is likely going to continue to support their trends over the next few years. However, their markets are quite expensive relative to, let's say, the Korean or the Chinese markets. And as a result of that, whenever we have some whiff of global trade bottoming out and turning up, usually investors tend to go to North Asian markets rather than Southeast Asian markets. So that's why Southeast Asian markets, especially, let's say, Malaysia and Indonesia, over the past few months have been lagging the Chinese and the Korean markets. So I think that it's like Southeast Asia is like your consumer staple, a long-term defensive growth market, whereas North Asia is more like a cyclical. And when global trades bottoms out and turns up, people tend to chase the cyclicals more than the defensive growth.